Yes, most of us are investing for some form of financial freedom, or maybe even to have the option to retire early. There are many obstacles in our path in order to achieve this desire, and actually the biggest obstacle is ourselves. As part of that, the mistakes that we make. The stakes are high, ladies and gentlemen, and our financial futures depend on avoiding and minimizing as many of these mistakes as possible. So I've got 5 of these that I'm highlighting for you to avoid in 2022. The biggest mistake is actually quitting, hence the thumbnail why you may have clicked on the video originally. Tesla is our starting example. Now, if you're a long-term investor in Tesla and you didn't quit, you could have reaped a substantial reward. You can see from this period of 2014 to sort of early 2020, perhaps the end of 2019, the stock price did very, very little. If you've done your due diligence and you were convinced in your research, had conviction in your plays, and you were patient and did not quit, you then reaped your reward. Very important not to quit. If your research tells you that you're right, things can take 1, 2, 5, even longer years in order to show up. Can you imagine how many investors quit even though they were convinced in the company and had done their diligence? I can imagine between 2016 and 2019, there's probably thousands of investors that sold Tesla stock thinking, oh, I've had it for years, nothing's happening, let's rotate into something else. I'm fed up with this, it's not working. How would you feel if that was you? That's one of the biggest mistakes that can derail your progress to your objectives. Now, there is an alternative scenario because you may not be an active investor, you may be a passive investor just buying into the market itself. So let's have a look at the S&P 500. We're going to go back to the 1970s. If you have a look here at 1972, start of 1973, the market's at about 120. Dip, increase, dip again, and it took till mid-1980 to get back to that 120 level. So, 7 years or so, 7.5 years. So if you weren't patient and you weren't averaging in, reducing your average, then you would have lost out on some excellent returns. And this is a repeated thing over the long term in the market. Late 80s, there was a shorter version, 87 to 1989, 2 years. But, the biggest one of all, if you were investing in around about 2000 at, let's say, 1500, you're talking 2007 to get back to that level, and then it pretty much immediately crashed again. And then to get all the way back to 2013, so you're talking 13 years and the market done nothing. If you sat there and looked at it, it's done nothing. But actually in that time, if you didn't quit, you'd be first of all receiving dividends. That would be boosting your portfolio. Secondly, if you had additional cash, you'll be lowering your average, dollar cost averaging as well, taking advantage of those dips. So if you, instead of quitting and thinking nothing's happening, you could be lowering your average, which increases your return in the long run if it goes up, and you'll be collecting dividends. So first thing here is it's really important not to quit where your research and history shows that actually that would be really detrimental to achieving your long-term objectives. So don't give up easily. It's really, really important. I can't stress enough. This is a long-term game. It's not a sprint. Hit your objectives. Don't give up. Stay tuned to the end though, because I've got some really big ones coming up here, some really big tips. Can you imagine how you'd feel if you look back, let's say on Tesla, and you'd sold in 2018? Not only have you been derailed from essentially hitting your financial objective, you're then going to have anxiety, then going to feel kind of anger, resentment perhaps, that you didn't stay the course, be angry at yourself. And then you might even go like chasing those returns on another stock, which isn't as good. So it's really important to have that discipline. So you'd avoid all that anxiety. You can avoid all that tension by just not quitting prematurely. Be calm, have a long-term focus, and have conviction in your research. Moving on to something else that could really derail you, another obstacle here. Look, we've all chat to people, a lot of us that are really into stocks, particularly active investors, we all chat to people, say, look, what are you investing in? Have a look at this. And there's always someone that pipes up and says, oh, I made 1,000% on Tesla, or I made 500% on Bitcoin. It's something of that nature. Fantastic. Very pleased for everyone that does that. But you have to make sure that just because it's your mate saying it, you don't take that and go, right, this guy knows it. He's going to find the next one. So next time he buys something, I'm going to copy him because he got 500% on Bitcoin or he got 1,000% on Tesla. Just because someone did well on one purchase, it doesn't mean that they're going to do well on their next one. And the other thing is you may not have heard about the other side of the coin. Like, when's the last time your mate said, oh yeah, I've lost 50% on Boohoo? Like, how many people actually say that? How many people volunteer that? You only hear about the good things normally, and you don't necessarily hear about those negative ones or the things that haven't done anything for a couple of years. But actually, the whole portfolio is important. The big obstacle here is following what your mates say, what you hear at a party, or what someone you think is good has said. Don't blindly follow. Make sure you do your own research. Now, look, that transparency is important. That's why on this channel, I show all of my holdings. So if you click on the card at the top of the screen, and there'll be a link at the end, you'll be able to see all of my portfolio reviews, which I post every 1 to 2 months, all the holdings and the performance of those holdings. So for me, that transparency is important. You'll get that here. So like all these guys that made a load of money on Tesla, hats off to you. I didn't, and a lot of other people didn't. Then there's always that temptation to go looking for the next Tesla, whether it's for that original investor or for you because you've seen someone else do it. Don't get dragged into that, because the next Tesla, the next Amazon, etc., they're very few and far between, and the next something often is the next nothing. So be really cautious if you're looking in that mindset. Do very good research and don't overcommit yourself on looking for the next something. All of this information is to really help you overcome the obstacle of yourself. And for most investors, that is the biggest obstacle to their desire for financial freedom. You know, the stakes are high. If you've got a plan to retire 10 years early, if you want to retire at 55, if you want £1 million portfolio like myself, if you want XYZ, the stakes are high, the obstacles are there. And after this one, I've got 3 more obstacles for you to have a look at that will really help you in your desire to get to those goals. Now, don't rule out your mates completely or the people you follow. Now, there is very much something to be said for getting the ideas of other people. There's no prizes for being original or having the wildest idea or coming up with the most unique thing. So the third obstacle, the obstacle of self, the third thing is, you don't have to be original to win. You don't get points for the most original idea. You get points for making the most money. Or in fact, most importantly, you get points for making sure you're on track and hitting your personal investing and financial objectives. That's the most important thing. Doesn't matter where those ideas are from, it's irrelevant. Why not take advantage of Warren Buffett's 65, 70 years of experience at 20% a year compounded? Why would you not have a look at his quarterly submissions to see what he's bought or sold? Don't follow them blindly, because what he does may not work for your situation, may not work for your portfolio, or you may disagree on certain companies. Like not too far before COVID, he bought a load of airlines. Didn't work out so well. Not his fault COVID came. I think in the past he said, if you see me buy an airline stock again, shoot me, something along those lines. So people can make mistakes, people can change their views, but get ideas, do your own diligence. That is one of the key things, is being an obstacle is being resistant to using other people's ideas. And I'm about to show you on screen now how I've got some of my ideas for my top performing positions. Right, so what we've got on screen now is my 5 largest UK holdings in terms of performance, and that's compound annual growth rate, not total performance. And this information is all from ShareSite, which is a great tool, kind of bringing together different accounts and showing you your compound annual growth rate for everything. If you're interested in that, there's a link in the pinned comment below where you can check that out and get yourself a bit of a discount. So Investec, 84% a year on that investment, made in 2020. And that one I found myself using the Simply Wall Street screener. And then I went and did my own research after using that kind of filter. And then I invested, and thus far it's been successful. Our K3 Capital Group, now shout out to my mate David. We worked on this one together, kind of in conjunction with that stock screener as well on Simply Wall Street. And then we invested in 2020. And again, over 50% a year on that one, so it's done well. And it was similar for Duke Royalty as well. Now, BT Group is one I went into myself. I've been following it for a long time. The dip presented itself for 2020, and I added that to my portfolio. And then finally, Aviva again is something I found myself. The ADs for its stock screeners, looked at the price to book, thought that looked pretty cheap. I knew the company, I knew that there's a great product with good service, so then I investigated more and then purchased that position. Now, the US one's a little bit different. So the first one here, Contura Energy, otherwise known as AMR, coal miner. So 348% a year position. That one, didn't have a clue with that one in terms of finding it. Did not come at that myself. That came up from another YouTube channel, Investing Club. So this is Investing Club. He's not paid me to say this, just off my own bat. So shout out to him. He runs quite a concentrated portfolio, really clear analysis when he posts stuff. And this is where I got that idea from. So he comes up with some good ideas. So if you're looking for perhaps another source of ideas, I'd suggest that channel somewhere just to get the ideas from. And then, Ramaco Resources, the next one. Again, that was via a screener on Simply Wall Street. And then Bank OZK was kind of a combination of Investing Club and Phil Town at roughly the same time, which was where I got that idea from. American Express, came up with that myself. I love the company, been a customer for years, and I wanted to get involved. And then 2020, a nice opportunity presented itself. And then finally, InMode. So InMode, actually got that idea from Jacob at JKR Investing. So another interesting channel if you're looking for some more ideas. And he's quite transparent with his portfolio as well. Shows all the positions. Kind of a bit bad timing on InMode because that was up 200% a couple of months ago, and that's really absolutely crashed. But it's a massively high quality company with really big margins, and they're growing fast, and they beat guidance. So if you're looking for perhaps an idea, I'd say have a look at InMode. But obviously, this isn't investing advice. As we said, do your own research. That's the most important thing. Take ideas from people, but do your own research. See if it works for you. So Peter Lynch in One Up on Wall Street is an absolutely fantastic book. Now, he suggests the more rocks you turn over, the more potential great buys that you'll find. So if you've got other people turning those rocks over for you, you're not trying to do it all yourself, why not take advantage of that? So use that network of people, and then whatever that network is, it'll be different for you, whatever investors or YouTube people or screeners you use, it's different for everyone. But take advantage of other people's work to at least find the ideas, and then obviously do your own research to top it off. But don't have the ego around, this has to be the most original idea, no points for that. So you can really avoid that obstacle by embracing the ideas of others and then adding your own flavour and research to it. Really important. It will help you get to that financial freedom, that retirement early, whatever it is you're looking for, because that's the end goal, and that's what we're trying to avoid all the obstacles on your way to that. Look, our fourth one here is selling whilst you're down, and that will really, really impair your quest for financial freedom. Because if you sell whilst you're down, you lock in a profit. You are guaranteed to lose money. And Warren Buffett's rule 1 is don't lose money, and you are accepting the loss of money. Now, there's one thing to sell when you're down if the fundamental position of the business has worsened and it's no longer a sound investment. That makes total sense. I'm talking about selling when you're down because the price has gone down. So you guarantee a loss. And if you guarantee a loss, in your next investment, you not only have to make the return for that investment, let's say 10% a year, but then you also need to make back the money that you've lost. So maybe you need 20% a year on that one. And you start getting to 20% a year or more to consistently do that, very, very difficult. You absolutely can't afford to keep losing money because it will really impair your progress to that goal. It's all about that long-term goal, kind of laser focus on that. So the example I bring to you today is actually the best performer Contura / AMR, as they're now called, the coal company, coal miner. So back in 2018, if you were into this one, let's say there's a little dip here, and you bought, let's say here at sort of $70 per share. And then it went up a bit, so you're happy, like 77 almost, and then down to 63. So you think, right, it's gone down, I bought a bit more. And then end of 2018, and you can see it's just dropping. You get to sort of mid 2019, you're at 50, and then not too long after, you're at 38. So you're getting towards 50% down. Let's say you average in, you're following your good metrics, you average in, then you're at 31, you're at 27. You move along here, then you're at $7 a share, 6, 5, 4. You bought at 70, are you going to be holding at 4? Are you really? That is the real test of investor. Having been averaging down is one thing, but are you still going to hold it when you go from 70 to 4, like 2, even it went down to 2, right? So 72, you're basically at 95% loss, something like that, like almost 100%. Now, if you sell here because you're scared, you lose almost 100% of your money. But if you have averaged in on the basis that you believe the company's sound or the cyclical nature of this market, there's going to be an improvement. Look what happened. If you got your average down to, let's say, 30, you're going up, went up, and you're into the 60s. And in fact, but a few days ago, it hit the 70s. Back to where it originally was, only sort of three and a bit years ago. So not that long in investing terms. So if you had a company that's gone from 70 to 2 and back up to 70, and you knew about them and you liked the company, the industry, you have the opportunity to buy at 2, it's 70. Whereas some people would have sold out of fear. So selling out of fear in that situation, if the fundamental basis is still sound, It's a massive obstacle to hit your financial goals. It's really important not to sell and be strong when something's down. Trust your analysis. There's no harm in looking at other points of view, but the fundamentals at the end of the day, what's happening in the market in terms of the financials, the price of the commodity, what have you, really do the research, because if you know what you own, then you'll be fine. Part of the reason Warren Buffett's in Omaha and not in Wall Street is he can detach himself from all of that noise, all of that emotion, all of the excitement, all the fear. And it's a very good idea for you to be able to do the same. Don't even bother trying to predict what the market's going to do in the short term, but the fundamentals will win in the long term. If it's dropping to 2 and you see it going down, 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 some people sort of sell out and try and buy in lower. It might work for you, it might work a couple of times, but you cannot predict and you could get stung by it. Don't game it, don't try to predict the market. No one can on a regular basis to that degree of accuracy. And also remember, even if the market overall is dropping, it's a market of stocks and not a stock market. So your individual positions, if well researched, they're strong companies, they're growing, they're beating expectations, like Dropbox in mode at the moment, for example. These companies, although down a bit from where they have been, because the market is in general, they will continue to grow and they'll do well even if the market isn't, because they keep beating expectations and they keep generating a lot of cash and they're growing. So if you're wondering where these ideas are coming from and how I kind of build my bank of information for, mistakes to avoid, best practice, etc., one of the best books is this fantastic book, What Up on Wall Street by Peter Lynch. It's written in plain language that someone new to investing can appreciate, but also for those that are more seasoned investors, it will still contain a lot of good tips and information. Highly recommended, several billion copies sold, and it's all available at the Finance at JCL bookstore. So investing books that I've read and highly recommend, you'll be able to find there. And it also helps support your local bookshops with donations as part of that process. And it also helps support this channel, helps me keep doing these videos. So I really appreciate it. If you're interested in these books, go and check it out. The final obstruction to achieving your objectives is actually not reading. This is particularly important for active investors if you're looking to buy stakes in companies, if you're looking to how to build a portfolio and manage a portfolio. It's really important to read. It builds information. Warren Buffett, Charlie Munger in their 90s, doing this, 60 odd years, even 70 perhaps. They keep saying, they're constantly learning. They don't know everything. They make mistakes as well, and they're still reading regularly. So you can get lots of best practice from lots of different people and build your own investing style that works for you, that works for your situation, and that you can actually then implement. So I would say read, because that's one of the biggest mistakes you can make this year as an investor if you're active investing. If you think about every possible mistake that could be made has been made by someone, probably by millions of people. Everyone's made all the mistakes that can ever be made. And instead of having for you to remake those mistakes, read about it, learn from other people, because you could perhaps avoid some of the mistakes that other people have made that potentially you might otherwise make. And I think, overall, that is the core idea here. All the different things that we talk through and obstacles. The more really you can do, the more obstacles you could learn to mitigate or move or reduce or even eliminate entirely, perhaps. And that will really push you towards that financial goal. Because if you can get rid of these obstacles and not lose money and not be suboptimal, then you're far more likely to be able to retire early or hit your target. And if you want to do a bit more reading and research, click on screen now and you'll be able to find all of the company reviews that I've done recently and see my view on some individual stocks.